So, welcome everyone to today's session. Review the draft Schedule 1A. Remember, this is in draft form, which means the IRS can change it all again tomorrow until they finalize it, is the true Schedule 1A. Most of what we see, based on my experience, what I've seen in the past, is there's very little changes from draft to final. So that's why I thought it was a great idea for us to look at this together, kind of get acquainted with it, and then start getting familiar with how we can start approaching our clients. What are we going to need from them? But before we dive into the session, I do want to make sure that I introduce myself to those that I haven't met yet. Very great to meet you, and I'm glad you're joining us today. My name is Nadia Rodriguez. I am an active CPA out of Dallas, Texas, where I do run a solo tax practice. It's just me with my clients, and I've been running it for over 15 years. But what I did in the corporate world from 8 to 5, and I did it for 8 years with Intuit, was software program developer. So they taught me how to write code using Java language. And this was our busy season. Usually, if I would have still been at Intuit, October through January 15, we are heads down writing code because we get access to draft forms like the one we're going to talk about today. And we analyze it line by line so that we can understand it and how it needs to be on the tax form or on the tax schedule so that we can turn around and write the code for that. But as of a little bit over 2 months ago, which I just have my 2 month, anniversary of jumping ship and being a full-time entrepreneur to run my practice and to run this community and education space. But with that, I am the founder of Nadia CPA Inner Circle, and welcome here today. Now, the new schedule is for individual tax. So if you have a business that you're filing a S Corp return, a C Corp, it's not for that. It's for your individual taxpayer. Schedule 1A. Additional deductions is the official title given on this draft form. Again, it's draft version, but most likely it's going to remain final, or there might be just some very minor tweaks. There are no instructions that are issued. We only have the face of the form. So a lot of the lines do say see instructions, and we're kind of like we're lost because we don't have instructions that are released yet, and we're just kind of making assumptions on what the instructions would say. So it was first released September 12th of 2025, and the tax form has to be filed with the tax returns for 2025 tax year. So yes, you're going to be familiar with this schedule coming January, if you start tax season in January, all the way up to April 15 for your individual taxpayers. Now, the purpose of this new schedule is the One Big Beautiful Bill. With the One Big Beautiful Bill, we do have 4 new deductions that came. Of course, the bill covers a lot more than just these 4 deductions, but the Schedule 1A really just focuses on the 4 new deductions that are available to individual taxpayers. And they are the qualified tips deduction, the qualified overtime deduction, qualified car loan interest deduction, and the enhanced senior deduction. Now, I will give you a very high overview just to get you reacquainted with what these deductions involve. But if you really want to get more into these deductions and the One Big Beautiful Bill, we do have available a whole maybe an hour and 25 minutes of a webinar in the general community. It's for free access. You can access that whole webinar and really deep dive into what all changes are coming with this One Big Beautiful Bill. But when we talk about the Schedule 1A, it talks about deductions that are below the line. And you're going to see that referenced in maybe instructions or maybe in articles that you see published online when we talk about below the line or above the line. And what line are we really talking about? Well, if we look at our Form 1040, it is line 11, AGI, adjusted gross income. Any adjustments that happen above that line are referred to above the line, because we know that the 1040 starts off with just building your income. Let's bring in all income because that's the general rule with the US tax system. You get taxed on all of your income except those that there's an exception or there's an adjustment available to reduce that income. So yes, at the top of 1040, we see wages, we see business income, and then we see some adjustments like the educator expenses, right? That's up to $300 for those teachers spending their own money for their classroom. They can take a deduction above the line to reduce that income to arrive to adjusted gross income. And then we have deductions that are available to us below the line, which happen after the adjusted gross income line. And so the most common that we know, and there's only 2 that's available starting 2024 and before, is the standard deduction or the itemized, if you have more itemized than standard deduction, and then the QBI deduction. And we see that where the QBI is 20% of the active income in a trade or business. Those were the only two deductions available to us as of today, 2024. Starting for the year of 2024 tax forms, starting tax year 2025, there's going to be a lot more because those one big beautiful bill deductions that came through, the 4 new deductions, they're going to be below the line. They're going to be treated just like standard deduction is, just like QBI deduction is. And so we have that at the very bottom, we see here on the bullet point. But if you remember the 1040, if we're taking a quick look at the 1040, below the line, there's line 12 and there's line 13. And then we arrive to taxable income on line 15. Not much room on page 1 of the 1040 to add 4 new deductions. So then what happens? The IRS created a Schedule 1A for us to include all of those 4 income deductions, and we can then plug in the total deductions into the 1040, which the 1040 draft is out there already, and it did significantly change, as in like the format, the layout, but really it's just the same information with a new line, and we'll see that with the new line of Schedule 1A. So why is it so important for us to distinguish between above the line and below the line deductions? Because we know that the deductions that happen below the line do not affect adjusted gross income, right? They happen after the fact. And what they do is that they reduce the number that is computed for adjusted gross income to arrive to taxable income. And again, we've only been used to 2 deductions, standard deduction or itemized, and the QBI, the qualified business income deductions. Now, why does it matter? Because AGI, the line 11, the adjusted gross income, that number is used to compute a lot of other credits, a lot of other deductions. And so here I've listed some of the most common ones. Child tax credit. That one depends if you're a high income earner. If your adjusted gross income is greater than the 200,000 or 400,000 if you're married filing joint, you start phasing out of that child tax credit. Earned income credit depends on that AGI, on that modified AGI, and we will talk about modified AGI because there's a difference between AGI, which is on line 11 of your 1040, and modified AGI. Modified AGI, there's no line on the 1040 that gives us that number. Instead, we have to compute it. So I'll let you know how to compute it. But some of the other credits that depend on the total number of AGI, modified AGI, is your education credits, your savers credit, the premium tax credit that we have to pay back if our AGI was way higher than what we estimated that credit to be, and the adoption credit and Roth IRA eligibility. We know the Roth IRA, the retirement account, it's a pretty sweet deal because yes, you get to contribute into this retirement account. You don't receive a deduction today for it, for those contributions, but it grows tax-free. But it all depends on your AGI. If you're a high income earner and you phase out, you won't be able to do a Roth contribution. Now, there is a strategy called the backdoor, but that's out of the scope of this session. But just letting you know, AGI, a lot of the credits and deductions depend on that number. So yes, when it's a below the line deduction, it doesn't really benefit your AGI. It doesn't benefit you to allow you to qualify for more credits because it happens after the line, below the line. Now we talk about modified adjusted gross income. Modified adjusted gross income, like I said, it's not a line item on your 1040. Instead, we have to compute it. And some of the forms that we do see compute this for you with you filling in some line items, but really you take line 11 of the 1040, which is AGI, adjusted gross income, and then you're going to add back all of that income that you were able to exclude to arrive to AGI, which talks about more foreign income. Any excluded foreign income gets to be added back to adjust your modified adjusted gross income. Now let's get into the 4 different deductions that come with the one big beautiful bill. Now these are temporary deductions, which mean they're going to be active from the year 2025 all the way up to 2028. 2029, if nobody extends it, if we don't have another tax bill, there's no president that proposes anything in their campaign, 2029, they're completely gone. Schedule 1A will be obsolete. But for now, we get to enjoy this type of deduction. The no tips no tax on tips deduction. Now, this is how it's referred to in the actual One Big Beautiful Act in the bill itself. It's really a tip deduction. The no tax on tips gained a lot of popularity during the campaign because it really makes it seem like there's no tax ever on any type of tips. But there's limitations. As we can see here, yes, if you do receive tips as compensation, as part of your compensation, you get to deduct up to $25,000 of them. Yes, you'll claim them as income as part of either line 1 on your W-2, or if it's a business like you're a Lyft or an Uber driver and you receive tips, it's going to be part of your Schedule C income. But then you get to receive a deduction to lower that income of up to $25,000. Now, they do have to be qualified tips. What does that mean? It means that your industry had to have been customarily been receiving tips before January 1st of 2025. So we can't just say that as of today, my business will start receiving tips unless your industry was accustomed to receiving tips. An example can be like if you're a retailer of online, maybe online you sell clothing. Typically, nobody tips those kind of industries. So yes, you can't just today say, I'm going to add a line on there where tips can be added if the consumer wants to add tips. You won't qualify for this type of deduction. Now there's a phase out. Not everybody would qualify for the deduction up to $25,000 if you're a high income earner. And it all depends on your modified adjusted gross income. That's what determines if you're a high income earner. If you're single or any other status except married filing joint, once you hit $150,000, which is really not that high, right? That's more like a mid to like lower income if you're single or any other kind of filing status that's not married filing joint. Or if you're married filing joint and it's $300,000. Once you hit those modified adjusted gross income limits, at that point, that $25,000 starts to get reduced down. Now, we do say up to $25,000, which means that if the taxpayer received tips of $30,000, then they can only take $25,000 of a deduction. But what about if that taxpayer received only $10,000 for the whole year? Then that's the max that they can deduct as a tip deduction. They can't go above and beyond what they have received in tips. So it's only up to the amount of tips you receive, limited to $25,000 of a deduction. Now, the deduction, once you hit that modified adjusted gross income above these limits, you need to start reducing that $25,000 by $100 for every $1,000 over those threshold amounts. And of course, with the One Big Beautiful Bill, there's a lot of emphasis on Social Security numbers requirements. So for this type of deduction, your taxpayer must have a valid Social Security number. I know there are Social Security numbers that are issued for that are temporary Social Security numbers just for the purpose of work authorization. As long as they are still authorized to work, it's a valid Social Security number because it does say the Social Security number, but it has to be authorized to work. Again, like I said, it's a temporary provision. We only get to enjoy this type of deduction up to the tax year 2028. Then we have the overtime deduction, or what they called as no tax on overtime. Now, this is a deduction up to $12,500 of your overtime pay. Now, I know it sounds pretty nice, but it's not, because really, if you get paid hourly and you earn overtime pay, most of the states are paying you, or most of the employers in states pay you 1.5 times of your hourly rate. When we talk about overtime pay, it only counts for that half extra. I'm going to do a quick math for you. If somebody gets paid $10 an hour, regular pay, and they put in some overtime, their overtime pay would be $15 an hour, right? 1.5 times of what they get paid, which is half of the $10. Well, only that extra $5 accounts for the overtime pay. We have to take that $5 times the hours of overtime that they worked. But again, we also have a phase out. Not everybody would qualify if the modified adjusted gross income is the same amounts that we saw for the qualified tips deduction. $150,000 for single, $300 for married filing joint. At that point, anything above starts to reduce to $12,500 of a deduction for overtime pay. Again, an authorized Social Security number that is for work is allowed or is required for this allowed deduction. Temporary provision up to 2028 tax year. Then we have the car loan interest deduction. No tax on car loan interest, which I've seen some TikTok videos about this. Not all of the loan interest qualifies. There are some stipulations. One of them is yes, it's a deduction up to $10,000 of a car loan interest deduction, which I have yet to meet somebody that pays that much interest in a year for a car loan. I think the average, when they did surveys and studies, the average American pays about $2,500 to $3,000 on a car loan. We talked about this during a class. Well, what about if the car is one of those really expensive cars that are worth over 100,000 and the interest is really high? Maybe you do get to pay $10,000 of car loan interest for the year. However, it can't be a high income earner because again, we have modified adjusted gross income thresholds, which we see here are lower, even lower than what we saw for the no tax on tips and the no tax on overtime. $100,000 for those single taxpayers or $200,000 for the married filing joint. So again, those type of taxpayers, I doubt they're going to be buying those vehicles that are really expensive where they really have to pay more than $10,000 of a car loan interest. But if they do and they still qualify for these income thresholds, the max deduction is $10,000. Now, it has to be a loan that originated in 2025. So it could have been an old loan. Maybe you bought a car back in 2024 and you're still paying interest on it. You still carry the loan. It can't qualify no longer. It has to be you went car shopping in the year 2025. And it's a, excuse me, it's a provision that's temporary. 2025 tax year is the first year we get to enjoy this deduction, but the year 2028 is the last year that this deduction will appear on the Form 1040. And then the last deduction that is allowed, that came with the One Big Beautiful Bill, that is available to those individual taxpayers, the enhanced senior deduction, which this one, there was a lot of confusion when the bill got passed back in July, on the 4th of July, because even the Social Security Administration issued a notice and a letter, email. My parents received an email congratulating the president for signing this type of One Big Beautiful Bill. How amazing it was because there was going to be no tax on Social Security benefits. Well, that was incorrect because it's not really you have to receive Social Security benefits to enjoy this deduction. No, the only requirement is that your age. You have to be either 65 or greater than 65 years old. And it could qualify for taxpayer and spouse. Each of them could receive up to $6,000 of a deduction on their Schedule 1A. But again, we come with modified adjusted gross income thresholds. And look at the amounts, it's even lower. It's $75,000 for single taxpayers or $150,000 for married filing joint. And a Social Security number is required. It's one of those that's authorized for work. Temporary provision as well, 2025 through 2028. But with that, we've looked at a big overview of the 4 new deductions that come. Again, if you want to dive more into it with examples, we have that webinar available for you. But for now, let's go ahead and analyze this draft form of the Schedule 1A. Now, I did screenshots and I divided it because it has different parts to this. But now that I've given you a high overview of the deductions, and we're going to look at line by line of the Schedule 1A, it's all going to start to come familiar. And exactly what I just mentioned is what you're going to see on the Schedule 1A. At the very top, we have modified adjusted gross income. This is where we are computing, and I gave you the formula earlier, right? You start at the very top with Form 1040 or the 1040 NR, the SR for the seniors, line 11. That's your starting point. And then you're going to add back all of that foreign income that you were able to exclude to arrive to AGI. We're going to add it right back. And it's going to increase our AGI to arrive to modified adjusted gross income. Now, this is part 1 at the very top of the form because we are needing to compute this number because the deductions, how we saw, are limited to modified adjusted gross income. We start to phase out. So that's step 1. Let's compute modified adjusted gross income. And then we go into tip deductions, the no tax on tips. Now we see at the very top the caution text. It does say only if you have received qualified tips. So we have to be very familiar on what do they mean by qualified tips. We talked about one of the qualifications. You have to be in an industry that is customarily used to receiving tips. Also, qualified tip is one of those, it's an amount that's not negotiable, where you, as the one receiving the tip, has no influence on how much tip somebody should pay you. There's more things about what is a qualified tip, and we can see that with the webinar when we really dive into qualified tips. But they do kind of remind you here on the face of the form of the Schedule 1A, it has to be qualified tips. And then they also remind you you have to have a valid Social Security number in order to claim this type of deduction. So if we look at the very top of part 2, regarding the tip deduction, how do we know how much tip we received? Well, the IRS is depending on W-2 Box 7 and also Form 4137 Line 1C. If you're familiar with 4137, that is the allocated tips. That's where you have to figure out how much Social Security and Medicare tax the taxpayer has to pay on those allocated tips. Because there's a general rule with restaurants, with the food and beverage industry, that usually their employees are supposed to receive a certain threshold amount of tips. Now, if the employee didn't report as much tips and maybe they fell below that threshold, then the employer is going to allocate what they think they should have reported on the Form W-2 as allocated tips. And then we have to file the Form 4137 to have our taxpayer pay that Social Security, Medicare tax on those allocated tips. So those are the two line items that we're going to be picking up in order to determine what the no tax on tips deduction would be. But then we also have, how about if you receive tips as a qualified business? Those, the barbers that have their own Schedule C, like I mentioned, the Uber drivers, the Lyft drivers, they receive tips as well. They're in an industry that it's customarily for those that receive tips. But if you did receive tips as that type of qualified industry, we get to take a deduction on those tips. But we get to pick up the amounts that are on and on your Form 1099 NEC. We see that on Box 1, Box 3 of the miscellaneous, and the 1099K Box 1A. However, as we'll see later in this session, these forms will have no change. They're going to look exactly like they do today for the year 2024. So how are we going to find out what the tips are on these 1099 NECs if there's no distinction on the forms itself? It's going to be communication with our taxpayer clients. I know that Uber drivers or Lyft drivers usually are able to print a report with their app that mentions how much their compensation was for the rides that they took, plus how much was allocated to tips, how much they received, how much that passenger paid them in tips. So there is a seclusion between regular earnings versus tips. What about your other industries? Like maybe the barber that's collecting money through Square, through maybe Zelle or something like that. That's the one that's going to have a lot of work to do on their hands because they're the ones that are keeping track of their own compensation, of their own income that they're receiving. Hopefully they're talking to their clients, hey, send me a separate payment, or maybe in the Zelle memo or in the Venmo memo, you're telling me how much of this amount is tips. Now, is that typical? Probably not. These self-employed taxpayers are probably not even thinking about this right now. They're going to start thinking about it not until it comes to tax time next year during February, March, April. But we can start communicating this to them if we have those self-employed clients that typically receive tips. Start going back in time, looking at your reports out of every income that you did charge for that haircut, for that facial, for that massage. How much was tips versus how much was your regular invoice that you were charging them? And we do know that line 5, before I go further, line 5, line 5 for qualified tips. Anything that comes from your business, it can't make you go into a loss. You can't deduct more in tips than what you have as a profit for your Schedule C. So it does limit it to that. Now, if we go into line 7, that's the number that we're familiar, right? On line 7, it's limited. This tip deduction is limited to $25,000, or line 5, it's limited to the amount of your business income. And then we see line 8. Remember, we're bringing down line 3 where we computed what modified adjusted gross income, because once we have that number inserted in line 8 of this part 1, or part 2 of no tax on tips, is when the phase out begins. Because if we're over those amounts of the modified adjusted gross income that's allowed, which is 150,000 or 300,000 for married filing joint, at that point the phase out starts to begin. We need to reduce that deduction. Now we have part 3, the overtime deduction. You see at the very top the caution sign. Again, only if you received qualified overtime compensation. Now, what do we mean by qualified overtime? We talked about that time and a half and how only half of it is allowed as an overtime compensation. We need to look more into the law, and hopefully the instructions for this schedule give us more guidance on how to compute this. Is there an employer report that we're hoping comes with the W-2 to really tell us how much is overtime pay under this law of the no tax on overtime? And again, a reminder, a Social Security number is required for us to benefit from this type of deduction. Then we talk about W-2 box 1. It says, hey, what's your qualified compensation included in box 1 of your W-2? We know that box 1 of the W-2 is going to have a combination of regular pay and overtime pay, if any. Now, how do we find out how much we can take out and drop here on line 14A? Again, we're hoping there's a report that gets issued by the employer that the employee can access maybe their last paycheck and see the year-to-date compensation. Again, this is going to be some more work on our part to help our clients, because I doubt that if we ask our clients what was your overtime pay, that they will know on top of their head. They're going to ask us, well, how do I find out? And so it's going to be us analyzing this payroll, the last payroll, maybe their year-to-date compensation paycheck stub does show a distinction of the overtime versus the regular pay. But again, are they going to break it out to tell us exactly out of that overtime pay how much is qualified, which is only the half portion of the overtime pay? Still a lot of speculation and anticipation for more guidance. Also, we have the 1099 NEC. A self-employed person can be a contractor, independent contractor, where their contract states instead of a salary amount or a full amount, they're probably an agreement where they're getting paid hourly. And if they work overtime, then that's the point where we can start figuring out what the overtime pay is. Again, we wouldn't be able to pick it up from box 1 directly. We can't do 100% of box 1, because I doubt that person got paid 100% just overtime. And even if they did, we need to find out only the half of that overtime compensation. But this, to me, would maybe trigger some IRS flags of if we are showing exactly 100% of box 1 on line 14B, because the IRS is going to know not all of it is overtime pay, qualified overtime pay. Then again, we go through the computation of the limitation. It's up to $12,500 of an overtime pay deduction, or if both spouses or if it's married filing joint, then it's a $25,000 deduction. Now, this is really interesting, because what about if only one of the taxpayers is the one working a lot of overtime and the other spouse isn't maybe even working? They could qualify as a married filing joint return up to $25,000 of an overtime deduction, even if only one of them was the one earning that overtime pay. Then we go into the modified adjusted gross income, right? We need to bring that number again, because we need to run that deduction, allowed deduction, how much is allowed based on your modified adjusted gross income limitations. And then we start with the phase out, just like we did with the no tax on overtime. Now, the car loan interest deduction. This one, again, I told you on social media, I've seen it all over, but they don't really tell you the ins and outs and the rules that we need to follow when it comes to car loan interest deduction. But we do see at part 4 at the top, again, they're just telling us qualified passenger vehicle loan interest. What do they mean by a qualified passenger vehicle? It has to have been final assembly here in the US. It must have been bought with the intent to just use it personally, not for the business. You can't buy it 100% for business use or under the business's name if you're for you to qualify for this, because we do see here to see instructions. That's what I'm just notating. I'm very curious what these instructions are going to say, if they're going to shed some more light, more guidance into many of the questions that I currently have. But look, we do have to put the VIN. We have to ask that client for the VIN if they do qualify for this car loan interest deduction. What's interesting here is column 2 of line 22. You have to reduce that car loan interest by anything that you deducted on Schedule E, Schedule C, or Schedule F. So, yes, you could have bought this car for personal use, and then you started a business, or you just started driving it for the business that you currently have. We know we can do that, right? You can use a personal vehicle for business purposes as well. We just have to allocate based on the business mileage log what percentage is for business expense versus what percentage is not. It's a personal deduction, right? It's a personal expense, which is not deductible. We can't deduct personal expenses unless there's a law that allows us to do, which is this right here. Car loan interest. We're using the car for personal reasons. We can deduct some of that interest expense. But yes, you need to reduce that interest expense by what you have already deducted on these schedules for the business. You can't double dip. And then here's the limitation. We learned that earlier, the deduction for the car loan interest is up to $10,000, which I'm very curious to find out from anybody on this call. Who has anybody come across a client, or are we going to find this out? We should share this in tax season. Did you come across a client that paid very close to the $10,000, or that is really benefiting from this new law? This law how it was issued in the campaign, how amazing it was, a $10,000 deduction. And then, of course, we come with modified adjusted gross income because we have to go through the limitations and we have to go through a phase out if that modified adjusted gross income is above the limits, which we did learn here on line 26. Car loan interest deduction, it's a lot lower. Well, what I consider a lot lower than the other deductions, right? We start at $100,000 or $200,000 for the married filing joint couple. And then our last deduction that comes with the one big beautiful bill, the enhanced senior deduction. Here's where we start learning at the very top, or we see here the valid Social Security number. Again, it's a reminder for all of these deductions about the Social Security number, which, by the way, if we look at the car loan interest, there is no requirement for a Social Security number for the car loan interest, which is pretty nice. Compared to the rest of the deductions. If we go back to the senior deduction, yes, they require the Social Security number. And then here's where they check your age. But it's really interesting how they drafted this form, because line 31 and line 32 just talk about, hey, what's your modified adjusted gross income? Then let's look at the limits of that modified adjusted gross income. Let's go through a phase out of the $6,000. This is even before we even know if we qualify for the deduction based on age. We first have to just find out your $6,000 deduction, reduce it for the phase out, and then now line 36A, hey, check the taxpayer. Were they born before January 2nd of 1961? Are they 65 or over? What about the spouse? Because she would qualify, or he would qualify also for another $6,000 if they've met the age requirement. And then at the bottom is where we have line 37, the total allowed deduction. And we end Schedule 1A, where we bring it all together. All of those 4 allowed deductions, if they qualified and there was phase outs after the phase outs happened, we bring it all together to line 38. And Schedule 1A says, okay, you've computed it. This is your grand total deductions based on the one big beautiful bill. Now send this amount over to Form 1040 because we are going to make it fit now on the new page 2 at the very bottom. Remember, it used to be adjusted gross income, used to be on page 1. We see line 11B is new. It used to just be line 11. Now for the year 2025, it moved down to page 2, and we see line 13B. That's where we're squeezing in the grand total of all of those 4 new deductions that come with the one big beautiful bill. Of course, we still do have the standard deduction and the qualified business income deduction. But if we look at, this is just a draft form. We're analyzing, we're anticipating what's coming. But what do we know today? What are we certain about today? Well, the IRS did issue a notice, 2025-82, where they declared the W-2 for the year 2025 is not going to have any changes. And that's why on the Schedule 1A, they're saying, hey, go pick up box 1 of the Form W-2. But you only can pick up qualified tips. You can only pick up qualified overtime pay. There's not going to be any reference on line 1 where we can distinguish the rest. Line 20, or for the year 2026, the IRS has issued a draft W-2 where now it looks like there's going to be a new code added to box 12 where the employer will have the responsibility, or the payroll company will ask the questions to the employer. They're going to have the responsibility of really letting us know how much is overtime, how much is qualified tips. But for the year 2025, they've already declared they're not making any changes and basically try to figure it out on your own and trust the employer, trust the taxpayer that they're going to get the correct amounts. The overtime pay, again, we're going to use box 7. Again, we're going to ask the question, those allocated tips or those tips that are on box 7 as the W-2, were they all qualified? We're going to assume yes. The taxpayer, would they know? They probably wouldn't, but we're assuming if they're in the type of industry that customarily has received tips, they usually don't have an influence on how much of that tip can be paid to them. So it would be a qualified tip. We just need to make sure that the industry that they're in is one that qualifies for the tip deduction. And you know that for this tip deduction, SSTBs, which are specified service trader businesses, do not qualify for this deduction. I mentioned it, like you and I, we are here preparing tax returns, providing amazing service to our clients, to where if our clients pay us a tip, we're not allowed to take that deduction because we are a specified service trader business. Now, overtime pay, we're hoping the employer issues some type of report that gets attached to the W-2 that really details the overtime pay. If not, again, it's one of those that we're going to have to start getting really hands-on with our clients about, let's look at paycheck stubs, let's look at contracts. It's going to take a lot more time. Or we can just have the client try to figure it out on their own. If they're not going to pay us for the service of more of an advisory and more of a helping them figure this out. Also, they've issued that there's not going to be any updates to those forms 1099s. We saw on the schedule draft 1A where they say just pick up the box 1 amount, but only pick up the qualified tips amount, only pick up the qualified overtime pay amount. Again, it's us working together with our clients because there's no changes for the tax year 2025 forms. And so they've also issued just recently IRS or Internal Revenue Notice 2025-105, where they're saying because the law was, when it was written and it was approved, the law did mandate for those lenders, those financing companies that are collecting car loan interest in income items from their taxpayers, they're the ones that are borrowing this money for these vehicles. The law does say, hey, you have to issue those taxpayers some type of form that tells them exactly how much they paid you in interest. Think about the Form 1098. That one reports the total amount that was paid in mortgage interest. I'm assuming that that's the type of form that was going to be issued for those financing institutions. But they just said, the IRS said, don't worry about trying to figure out what form to issue. You won't get penalized. I know the law mandates for you to issue a type of notice, a type of official form. But honestly, the IRS hasn't got around to drafting any type of form. So they've issued relief. You won't be penalized for not issuing the specific statement as long as you do provide your taxpayer, the one that you are collecting the interest from, you are providing them a way on how they can determine the total amount of car loan interest that they paid you. Is it through an online portal? Is it through their statement? This is what I was thinking anyway, to ask my clients for maybe the year end, the December statement that shows the total interest paid, which I have asked for it anyway. Whenever we do take, whenever they use their vehicle for the business and we're taking actual expenses, that's where I start pulling out those. I start asking my clients, let me see your December statement because we need to allocate some of that interest income or that interest expense that you paid over to Schedule C as a deductible interest expense amount. So we need to start preparing for tax season 2025. And how can we do that with the information that we know today? I would start analyzing my client's modified adjusted gross income, even if we start at adjusted gross income. Now, that's a lot of returns that I have to look through. ProConnect is a software that I do use, and it does help me run reports. If your software helps you run those type of reports where it shows you, instead of you clicking inside of every single return, how much is that amount? Are we close to that threshold of 150,000 or 300,000, or for the car loan interest was 100,000 and 200,000 for modified or for married filing joint? Are we hitting close to that amount, or are we above that amount? Because now we need to start doing some tax planning. Is there any way we can reduce that amount, that adjusted gross income? Remember, become familiar with those adjustments that are allowed above the line, like the educator expenses, like the traditional IRA contributions. Do they have a business? Maybe it's the time to let's start buying some equipment, anything to help you reduce that income to arrive to a lower modified adjusted gross income so that you can qualify. Of course, it all depends if this taxpayer meets any of the requirements for the four new deductions. Maybe you don't have a client that really receives overtime. There's no client that maybe gets paid through tips, gets paid some tips. They're not 65 and over, or they just don't pay. They didn't receive a new loan. They don't get a new loan for a car. Maybe they don't qualify. Then it's okay. We can exclude them from the list. Just extract those that really would be affected by AGI requirements. And again, I said just run a report of those clients that will be 65 or over if they're seniors. Now let's look at AGI, because there is that threshold requirement for the AGI, which was $75,000 or $150,000 for married filing joint. And start modifying your organizer. If you share a tax questionnaire, a tax checklist that you're providing to your clients, start adding these type of questions. Do you have a current loan on your vehicle? Yes. Was it originated in 2025? If yes, enter your VIN number here, because that's what we're going to need. We saw that on the draft Schedule 1A. We're going to be required to enter the VIN number in there. And if so, how much did you pay in 2025? Hopefully they're able to figure that out. If not, we can start asking for those year-end statements. Did you receive overtime pay? Did you? Yes. What's the detail? Can you provide us some type of detail? Or maybe your employer was nice enough to send you some kind of detail with the Form W-2. But with that, that was Schedule 1A. Again, it's great that we're able to see what the draft form looks like right now, gives us that insight, gives us that how can we prepare in advance instead of us finding out about this during tax season and really trying to get together our facts and trying to get our questions together. This gets us a good starting point to start thinking for those clients that are close to the AGI and those that qualify under some of these deductions that are offered, especially the one about the Social Security number requirement. You know, if that's one of those that they saw on TikTok or on social media, that they hear about these deductions, but they don't have a valid Social Security number, dear client, you won't qualify for those type of deductions.